All right, good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner here to talk to you about something very important in the world of infinite banking, whole life insurance, and Austrian economics. And so this episode today is really titled and centered around this idea of how does life insurance, specifically life insurance cash value, support Austrian economics? And if you are tuning into this episode, you probably are familiar with infinite banking and whole life insurance. You're probably a little bit familiar with Austrian economics. But in case you're not, we're going to really unpack the difference between Austrian economics and the opposing way of thinking, and really what that means and how that applies to life insurance. So, Bruce, thank you for joining me for this episode today. I know this is really something that's foundational and fundamental to much of what Nelson Nash taught on infinite banking and what you and I believe and what we think and what we teach. And so, most of the time, people who are following down that trajectory of reading, becoming your own banker, and getting invested in this idea. I should maybe not use the word invest, vested in the idea of using infinite banking. They're familiar with this Austrian economic topic and what that means. But let's go ahead and unpack that today. But Bruce, before we do, just I wanted to have your big picture thoughts on this concept and this topic in general.
Yeah, so Nelson was actually he told me once he thought that this concept came to him because of his study of Austrian economics. And Austrian economics foundation is sound money principles, and sound money principles would be in the simplest form: save before you spend, and that you would not increase the money supply just to try to solve a short-term problem, causing boom and bust cycles. Because the Austrians believe that if you can leave the economy alone, that even though individuals are in it for themselves, that they would actually maybe do things wrong in the short term, but it would correct itself much more quickly than trying to throw a lot of money at it, blow up this bubble, the bubble bursts. And so you're saying, well, we didn't throw enough money at it last time, so we got to throw more money at it and blow it up again. And then it gets even bigger and it bursts again. So Nelson believed that his study of Austrian economics brought him to the conclusion that of using whole life insurance to take the place of the banking system, because banks can actually do fractional reserve banking where they can increase the money supply, and insurance companies cannot, because you can only lend what you've already saved in the form of a premium. So that's the basic premise, and then we can get into it a little bit more deeply after that.
So, Bruce, I love that we talk from the vantage point of Austrian economics all the time on the show. And thank you for kind of unpacking what that even really means. So, Keynesian economics is really the opposite way of thinking about the world and solving financial problems and the government's role in that. So, Bruce, can you just kind of unpack the difference between, well, what Keynesian economics is, what Austrian economics is, and really the difference between the two?
Yeah, well, I would say the greatest difference is that Austrians believe in liberty, and liberty is about the freedom of choice of the individual. And the Austrians believe that the individual is out for themselves, and they will make the best decision for themselves and their family for them to be successful. And that gets misconstrued as individuals are selfish and don't take the consideration of society in general into consideration. But they believe that, yes, there may be some short-term greed in the individual, but that individual will not be able to sustain it for very long, because people will stop doing business with them, people will stop associating with them, so they will adjust their behavior so that it's best for them, because it's best for society. Because, or I'm sorry, it's best for them, and thus what's best for them will actually smooth out what's best for society, because each individual not only understands what's best for them, but if they don't treat society correctly, then society's not going to get what's best for them. They're not going to get what's best for them from society. Where
Bruce,
the
this actually
Keynesian,
makes me think. I'm just going to pause you there because I think of two things very quickly and clearly. One is that when you're on an airplane and they tell you if the plane has a problem and loses cabin pressure, put your mask on first and then help the children next to you. And so I'm practically always traveling with children. I just recently traveled for a conference and brought two of my kids with me. And I'm always reminded by the flight attendant or this, I think that's what they call them today. Make sure you put your mask on first. And if you don't, so if you're not selfish enough to serve yourself first, you're not going to be any good for the people around you because you're not going to have the capability to serve and invest in the lives of other people. And so that's one thing that I'm hearing as you're saying Austrians believe that they need to take care of themselves first, do what's best for themselves, which ultimately pans out to being the best in the rest of society. The other thing that I'm thinking of is Bob Berg talking about the go-giver and how those that serve the most they have compensation come back to them in the form of dollars. So dollars follow value. And the only real way that you can have sustainable wealth creation is by truly serving other people. And so those are just two big concepts that are supported by the Austrian economic way of thinking as well.
yeah. And so let's go ahead. I wrote a bunch of points down about uh, the Austrian view of the economy, and basically the reason they call it the Austrian view is as Germany was kind of the birthplace of thinking of economy not only from a local but from a global region, and some of the best thinkers were in that region along with Austria. So then because all those thinkers were coming out, they call it the Austrian um, economy. So here's some key points. I love this one. I talk about this all the time when the uh, current Democrat candidate was suggesting that she was going to stop corporate price gouging. I went back to my Austrian way of thinking. It says subjective theory of value. The value of good is determined by the individual's subjective perception of its usefulness, not by the cost of production. So a lot of people would say, hey, it costs me a lot of money to make this, so I need to charge this much for it to make money. Society, then the individuals say, that's not worth it to me. It's not useful enough for me to pay this amount. So then a person has to decide, can I figure out ways to more efficiently produce this product so that its value actually comes down enough that people then have the theory of value, the usefulness of it. And I make this comment all the time. I actually think I made this up. I never know what the things I make up or come from somewhere else, but I think I actually made this up. Businesses suggest the price. So that's what businesses do. They open up their store, they say, or you have a person that has a service, I'm going to suggest this price to you. How do they suggest it? They put it on their product and they put it on the shelf. If it flies off the shelf right away, that means that they didn't charge enough in their minds. So the next time they put it on the shelf, they suggest a higher price. If it flies off the shelf again, they put the price up higher. If it doesn't fly off the shelf, guess what they do? They lower the price. And they find a price where they can make the most money, where they're turning it over at a reasonable amount of time for inventory, but they're not turning it over so fast that they're not making the profit on it, which causes them a lot of other things in their profit margin. In other words, the labor to put it on the shelf, the labor to produce it, the labor and the cost to transport it to the store. So there's a balancing act, because a lot
Bruce,
of
this
people
actually, go ahead.
say we're just going to work on volume. Go ahead, and then I'll follow
It
up with
makes
that.
me it makes me think about when you're talking about merchandise and consumer goods, a shirt. A shirt isn't just like all shirts cost $23. It's not like that. I mean, because one supplier can have a $200 shirt and another supplier can only sell a shirt for $6.99. And the difference is the perceived value. It's not the supplier saying, here's the price of shirts. So I mean, you're not going to pay probably $2,000 for a shirt at Walmart, and you're not going to go to, I don't know, Macy's or shop at Coach and expect you're going to get a shirt or a purse for $5.99. You're buying a brand. And so there's a piece that it's all down to, again, consumer perception, and there's a lot more that goes into it. The if you're going to wear a brand name or you're going to wear a logo, the feeling that comes along with that is worth something to you. And you could then argue, well, are all companies that charge more for a shirt or a purse, are they all more profitable? Probably not, because a lot more probably goes into creating the association with that brand being a higher value as well. So there's a lot more that goes into it than just a corporation setting a price.
Yeah, I'm smiling because it reminds me my grandmother used to say, the more you spend on clothes, the less you spend on clothes.
Yes.
And I never understood that until several years ago. About 10 years ago, I decided I'm going to get my first custom made suit. And some listeners would actually probably fall over when I tell them, and some might say, well, that wasn't enough you spent. But I spent $2,500 approximately on a custom made suit. And the reason I did is because the clothier person convinced me of the value in two ways. The first way is they said, this is going to be perfectly fitted to your body. It's going to be the most comfortable thing that you wear in any situation so that you are going to wear it more often. The second thing is the quality of the not only the material, but of the timeless classic look. You're not going to replace it anytime soon. And they were
I
a
bet that was both
hundred,
true.
they were 100% right. I can put this suit on and I can sit on an airplane for 4 hours with the suit on and feel like I am in jogging pants. I mean, it's so comfortable. It's got a classic look. I bought sports coats before for $80, and then I put it in my closet. I wear it a couple times. It doesn't fit right. The lapel starts to curl. It starts to beat up on the material, and I'm like, oh, it's only been 6 months, but this thing looks terrible. So now what I do, I go out and I buy another $80 one. I just keep the process going again. And my grandmother is always in the back of my mind. And my grandmother did not have a lot of money, but she said that all the time. The more you spend on clothes, the less you're going to spend on clothes. And I find that that's the perceived value. So I was willing to spend $2,500 on this suit because I thought I'll stop spending $100 every couple of months on a suit,
Hmm.
and I'll look better, I'll feel better, I'll be able to be more productive, so on and so forth. So that's the perceived value that you're talking about.
Absolutely.
All
Absolutely.
right.
So go ahead, Bruce.
So then, my point is that corporations or businesses suggest the price, but people that buy it, individuals, they actually set the price according to their actions. The next part is time preference. People naturally prefer to satisfy their needs sooner rather than later. We know that from Parkinson's law, you know. So luxury enjoyed once becomes a necessity, which explains the existence of interest rates. So if you let the free market decide what interest rates are, then people are going to decide whether it's valuable enough. I want this now. I want this color television now. I can't afford it now, so I'm going to borrow. Well, if the interest rate is really, really high, they're probably not going to do it. They're going to delay gratification. If the interest rate is really, really low, they're going to say, heck, that's not that much. I'm going to do it. So interest rates are set by the premise that people want it now, and they're naturally going to satisfy their needs sooner rather than later. So that's the next thing that Austrians believe in, and that's what causes the boom and bust cycle. So governments want to spur growth, so they lower interest rates because then people can say, "Oh, it doesn't cost me that much in interest, so I'm going to go purchase it now." The next thing is entrepreneurship. The entrepreneur plays a crucial role in identifying and acting on market opportunities, driving economic growth. So entrepreneurs figure out a good or service that enough people need, that they will purchase it from them to make a good living where it's worth the risk. So they figure it out rather than a central government deciding, oh, I think we ought to give, production help to this particular utility or this particular good or this particular service. And they don't even know if people are going to buy it, but they're going to subsidize it and they're going to produce a lot of these. And then, they're going to have to figure out the demand. But by the time they figure out the demand, they're going to say, well, we just didn't do it well enough. So now they're going to pour more money into it. This is what government organizations do all the time. Why? Because it's not their money.
Mm-hmm.
If it was their money and they were risking their money, they wouldn't do it. But they think they know what's best for the overall economy. So they say, we just didn't do it well the last time. We'll do it well this time by just throwing more money in
So,
it. The
Bruce,
next
what you're
point. Okay, go ahead.
describing right there is Keynesian economics. So, we
Yes.
haven't fully defined that, but you're contrasting what Austrian economics principles are versus the opposite. So, let's go ahead and just define for somebody who's maybe not as familiar, what is the opposite of Austrian economics, Keynesian economics? How would you define that?
Well, the Keynesians believe that government first role in the economy. So the government needs to actually do things to control the economy because a central person, a central government, or they're looking out for the best for everybody instead of the individual looking out the best for them. The problem with that is that everybody's perceived value, as we just talked about, is different for different goods and services. So it's impossible to know ahead of time which particular good and services is going to actually perform well. This is why in communist type countries, you will have certain things where they will say, oh, we can't get bread, we can't get meat, we can't get this because they don't know how that's going to fly off the shelf because the price is set. People are not that enthused about actually producing it because their wages are set. And so they're like, well, if I work harder, doesn't make any difference. I'm going to get paid the same whether there's bread on the shelf or not. And so but the Keynesian attitude is, well, if we do it well enough, we'll eventually get it right. And if we didn't do it well enough, it wasn't because the system was wrong. We just didn't put enough government into it. So we got to put
Mm-hmm.
more government into it. And this is what Ray Dalio is talking about, how governments continue to get bigger and bigger and bigger and bigger because, oh, we just didn't do it well enough. So we got to put more government in it. It's not that the premise is wrong. We just didn't do it enough. And
Which
eventually then it collapses on itself.
which is really interesting. So basically, the contrast is Austrian economics believes the power should be in the individual. Individuals will make decisions that will ultimately be best for the overall economy without creating the boom and bust cycle. Keynesian economics says if people aren't spending enough money, we need to lower interest rates by not just they can't directly lower interest rates, they print money, pump money into circulation, which inflates the overall money supply, which brings down interest rates, which causes people to spend more. And they say, look, we did such a great job. And so they're trying to drive GDP and they're trying to drive consumer spending and even unemployment by manipulating the currency supply and saying we know best. And so really that's the Keynesian view versus economic or Austrian economic view. So Bruce, I just think that that was helpful maybe for somebody who's newer to some of these ideas. So you were on entrepreneurship and
Yeah.
going
So the
through.
entrepreneur, yeah. Okay. So we finished that one. So then or Austrians believe about market coordination. A free market without government intervention is the most efficient way to allocate resources based upon individual preferences. So this is what I was just talking about. where in a communist or a socialist type of situation, they determine how much should be allocated, how much bread should be allocated, how much meat should be allocated, how many shirts should be allocated, so on and so forth. But it doesn't incent people if you're also allocating in price controls and wage controls. It doesn't incent people then to try to figure out how much bread is needed, how many shirts are needed, so on and so forth. So Austrian, and once again, I'm not saying that the Austrian way of doing things doesn't have some short-term problems, because anytime you put it on people to try to figure out what's best for them, and what's best for them will then be best for society, you're going to get short-term waves of good and bad economic situations. The difference is that if people are looking at this from the individual level instead of this big government um, level, then the individuals as a collective will make changes very quickly relative to the government, because the government's going to say, well, we just got to let it go for a little longer. It just hasn't had time to do this. We'll pump more money into it and keep it going. And by that time, it blows the bubble up, and then it fails, and then it comes back down. Where individuals, they're going to be working normally on a 30 to 60 day situation where, hey, I want to get this, but no, I can't do it because I have to protect my family. I have to protect myself. I have these things that I want now. Because you want it now, you're actually going to smooth out those ups and downs, because you're not looking at it for the long term. You have to take care of your needs now. And that's why it should be more efficient if you leave it alone. That doesn't mean there's not going to be some pain for some individuals every once in a while, but it'll correct more quickly.
So, for instance, that pain might be individuals say, this is a time that I don't want to spend money. So they constrict their spending. So maybe that impacts retailers. Maybe it impacts auto dealerships. Maybe those organizations feel more of a crunch because people aren't spending money because they feel the need to conserve dollars at that time. And what you're saying then is that that alone would bring down interest rates to make the lending freed up so that people feel more comfortable to be able to spend because the interest rates come down on account of people's decisions rather than the government changing the money supply. Is that correct?
Not only interest rates, but just the cost of goods and services,
Mm-hmm.
the cost
Okay.
of labor. We see this in commodities such as oil, um, where people think this is crazy, but there's actually a really good series on right now called Landman. I believe it's on Prime or Apple. It's on one of those two. And it talks about the oil industry. And we're not going to get into whether oil is good or bad, but this is a great example of how economies would work if you leave them alone. So a lot of people think that if you invest in oil or natural gas, you want the price of that oil or natural gas to be as high as possible. But the investment returns are not based upon how high the commodity is. It's actually based upon a combination of how high the commodity can be sold for and how little it takes you cost wise to get it out of the ground. And so it's the difference, just like any other business. It's the difference in what it costs to produce it to what you sell it. But here's the difference: as the price of oil and natural gas goes up, then more people say, oh, I want to get into that business, or I want to get back into the business because I can make a lot of money. When that happened, land leases or land acquisition actually goes up because chasing, you have more people chasing fewer land leases and um, fewer land acquisitions. You have
So the
leases
cost of
on.
production is up then.
Correct. Well, I'm not finished yet, because
Oh.
that's only one part. Now
Mm.
you have leasing of vehicles, leasing of equipment to drill. Now you have a lot more people involved, and so there's an opportunity to steal labor from one organization to another. Hey, if you come over here, we'll pay you more over here. So now to retain labor, the labor costs go up. So now it might be $100 a barrel, but your break even point used to be $30 a barrel. And now all of a sudden to get it out of the ground, your break even point is $60 a barrel.
Mm,
So but guess what happens in the oil situation? This does happen. But then all of a sudden, when production costs go up, then people start getting out of the business because now we're not producing as much. You can't produce as much oil because production costs are so high. Then guess what happens to production costs? They go
that's
down.
fascinating.
Yes. And so then the best way to actually get returns is to keep that delicate balance between production costs and what you can sell it for. And
Wow.
Landman actually talks about this, but also political, like President Trump says, drill, baby, drill. The oil companies say, we don't care what President Trump says because we're glad that he wants to reduce restrictions, but we can't just start taking as much oil out of the ground and flooding the markets anyway, because that's going to affect supply. And if it affects supply, we're going to have too much supply. The price is going to come down. We're not going to be as profitable. If we're not profitable, then we actually have to lay off people. The land leases go down. The equipment leases go down. Those people make less money. They go out of business. So there's a balance, but that balance is
Fascinating.
caused by the free market deciding this, not the government coming in and saying, oh, I'll actually give you an incentive to drill more. So go ahead and do it. Well, you drill more, you take more oil out of the ground. Now it floods it. And another thing is cheap interest rates. When cheap interest rates, companies that have to borrow money, now they can borrow money to get into the oil business. Well, that causes more competition. It causes all costs of production to go up. Where if they have higher interest rates, then you actually have to save money or convince other people to invest, get into the oil business without actually using leverage. And thus your cost of production is relatively lower because you're not artificially increasing it by borrowed money. And so people get out of the business because they have an advantage over people borrowing money. It
That's
sounds like cash.
fascinating.
It sounds like cash value life insurance to me, because you're not inflating the money supply. Okay, so but if you look at it in real life, and this is what Austrians do, they say economists can write everything they want on a mathematical formula, but Austrians say it's not about math; it's about people's actions. That's a big difference. Where Keynesians would say, "Oh, look at this mathematical formula. If we do X, Y is going to happen." So then the final thing I think is what we've been talking about is this causes boom and bust cycles in the business cycle. So economic fluctuations are primarily caused by government interventions in the money supply, leading to malinvestments. In other words, investments that people would not do if money wasn't easy to get, which I was just talking about the oil fields. You think, well, heck, get, oil is $100 a barrel. I'm going to get into business, but I don't have any money. I'm going to borrow money because it's really low right now. And so you get into the business. And they believe that these booms are unsustainable. And that's what constantly happens back and forth, the boom and bust cycle. So that is the kind of the basis of Austrian economics. The difference is, here's the difference with Keynesian. I wrote a couple notes down here is Austrians believe free markets are inherently efficient and will self-correct over time. Once again, it's over time. It doesn't happen right away, but it happens faster because it's like the old thing, you can turn a fishing boat a lot quicker than you can turn an aircraft carrier. While Keynesian argue that markets can experience significant fluctuations in demand, leading to unemployment and economic instabilities. So they're saying that Keynesians are saying, well, that's great, but in those short terms, you're going to have instability and market fluctuation. We can fix that. The government can fix that to make sure that doesn't happen. So we're going to come in, it's like President Reagan once said, the most terrifying words are, I'm from the government and I'm here to
I'm here to
help.
help.
Yeah.
Yeah.
And so,
It also makes me think of like if you have an ailment and you just patch it over with Tylenol, that doesn't mean you're fixing the problem. And so, I mean, if you're just applying a Band-Aid on top of a problem, that doesn't mean you're fixing the problem.
yes. Okay, so here's the Keynesian key differences between Keynesian way of thinking and Austrian. Austrian economists attribute economic downturns to malinvestments caused by excessive credit expansion, which we just talked about, advocating for letting the markets naturally adjust during a recession, while Keynesians view recessions as a result of decreased aggregate demand and believe government intervention can stimulate recovery. So they're saying, well, there's not enough demand for these goods and services. So we're going to throw some more money into the system so people can then purchase those goods and services. And that does work for a period of time, but all it does is blow up these investments that people wouldn't do in the first place if money wasn't easy. And so then they come crashing back down. And then finally, their views on inflation. Austrians generally view inflation as a negative consequence of excessive money printing, while Keynesians might use a moderate level of inflation as beneficial for economic growth. I believe that this is this is why uh, the reason why they think that you need this is you need more money into the system to spur more economic growth. But now I believe that economies that then get so far down the road and they blow up their national debt like the United States has right now, they want inflation to happen. They want wages to go up because now they can tax a higher wage and get more taxes to pay off the debt. Now, that sounds, once again, mathematically, that sounds great. But what ends up happening in these situations, people start tightening their belts because they're looking at all these prices going up, up, and up. And they're like, I have the money to pay for it. At the very beginning, they do. But then they're like, oh, no, I'm going to start hoarding money. I'm going to start hanging on to money. And thus wages start to go down. But prices are slower to react downward. And there's pain points right there. It's a much greater pain point when there's really big inflation than if there is short-term inflation growth from a Austrian way of letting the market decide how the supply and demand curves work. So those are the main difference between Austrian and Keynesian.
So, as we bring this to a close, the question at the forefront, maybe of someone's mind is how do we see infinite banking from an Austrian perspective? And part of this comes down to desiring sound money solutions, desiring a stable currency, removing government interference with money and banking, which is needed for a free economy. And when you look at the way that the Keynesian viewpoint is to manipulate interest rates by printing money and also by having an inflationary loan system where the creation of loans because of fractional reserve banking puts more dollars into circulation in the economy, infinite banking is a counter to that. So if you look at sound money solutions outside of tying the dollar back to gold, outside of getting rid of the Federal Reserve, really the number one thing that you can do as an individual private citizen in your household is take control of the banking function. And in so doing, you're no longer adding to that inflationary component of the banking system, and you are privatizing your own banking. And by doing that, you're creating actually more, you're dampening that boom and bust cycle, you're strengthening the currency, you're strengthening the economy, you're strengthening the American monetary system as a whole by not participating in inflationary monetary practices. So, Bruce, I'm sure you would have a lot more to say about just whole life insurance and how to view that from the Austrian lens. But you've already said as well, life insurance loans, once you have the capital, you have the cash value, it's not inflationary. You needed the full cash value available in order to borrow against that. You can't say, well, I have $2 in cash value, I'd like to get $1 million loan against that. That doesn't work that way. That would be inflating the monetary supply because that would be putting more dollars into circulation than actually exist. But because using infinite banking and using a whole life insurance policy and borrowing against that cash value doesn't have the inflationary component, you're you're in a position of strengthening the currency.
Yeah, not only you in this is what Nelson, as being an Austrian advocate and a scholar of Austrian economics, this is what he recognized when he put guidelines to. You could always borrow from whole life insurance contracts, but he said, "Hey, if we could get more people to do this, not only will it help people recapture the banking function in their lives, so they have a lot more control, but what it also would help society in general because we're not inflating the money supply. And guess what? Then you won't have as much boom and bust cycles. It would be a lot easier on people worried about the economy. And so, in a way, Nelson once again was saying, if you take the banking function into your life, what's best for you, it's going to be best for society. Sounds like Austrian economics. You're
Absolutely.
yeah, you're taking on, oh, I don't want to take on the banking function that's best for me. And because I'm doing it what's best for me, then we're not going to inflate the money supply, which is going to be great for society in general.
So if you're interested in taking control of the banking function in your life and implementing these principles of Austrian economics, or even if you have been intrigued or inspired by anything that Bruce has mentioned today, just as he's talking about these two alternative ways of thinking about monetary policy and the right way to solve problems in our economy, we would love to hear from you. So you can send us a question. You can put a question on this video, or you can email us at hello@themoneyadvantage and ask a question. We would also love to help you work through this in your own life. If you're interested in taking over the banking function and using privatized banking, or what we call infinite banking, you can book a call with our advisor team at themoneyadvantage.com, and we'd be happy to step into a conversation with you to help you uncover and unpack these principles in your own life so that you can become a banker for yourself and then be in a position of creating that certainty and stability in your financial life. So, thank you so much for being with us on this episode today. We encourage all of your questions, your thoughts, and your feedback. We're so thankful to you, our listeners, and really just the ability that we have to be able to share these ideas and principles with you and be able to have those who are looking for this information be able to find it. So the more comments and likes and shares that you provide, the more we can use this content to reach people who are looking for these answers and solutions. So thank you so much. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.